In this video, I am going to share with you the latest on Yanlord Land stock performance and DBS's recent analysis. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics such as stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've also covered over 500 videos and over 250,000 watch hours as of September 2024. I also focus on topics related to regional and world economy. Today, we're diving into the recent developments surrounding Yanlord Land, a Chinese real estate developer listed on the Singapore Exchange. DBS Group Research has made some interesting moves regarding their stance on Yanlord Land, and I'm here to break it down for you. First, let's talk about the downgrade. DBS has changed their recommendation on Yanlord Land from buy to hold. This might seem counterintuitive at first, especially when you consider that they've actually raised their target price for the stock. So, what's going on here? The main reason for the downgrade is the recent rally in Yanlord's stock price. Since the end of September, the stock has surged by more than 60%. That's a significant jump in a short period. DBS analysts believe that this rally has already priced in the positive sentiment stemming from China's newly proposed economic policy measures. Speaking of these measures, on October 12th, China announced some new economic policies. These include plans to increase debt and reduce interest rates on existing mortgages. These are aimed at stimulating the economy and particularly the real estate sector, which has been facing challenges. Now, despite the downgrade, DBS has raised its target price for Yanlord Land from 67 cents to 70 cents. This new target price values Yanlord at 0.2 times the one-year forward price-to-book ratio. DBS considers this valuation reasonable, as it's in line with how Yanlord was trading during the third quarter of 2023. But here's where it gets interesting. DBS believes that near-term catalysts for further stock price growth are limited. Why? Because Yanlord has low flexibility when it comes to adjusting its project launches. This means that even if market sentiment improves, Yanlord might not be able to fully capitalize on it. Yanlord has been playing it safe during the property sector downturn. While this conservative approach has helped protect its cash flow, it's also limited the company's ability to quickly respond to market changes. This could be a disadvantage if the market starts to recover. Another point to consider is Yanlord's recent financial performance. In the first half of 2024, the company reported a loss of 486 million yuan, or about 89.3 million Singapore dollars. This is a significant swing from the 1.1 billion yuan profit they reported in the same period last year. DBS expects Yanlord to continue recording net losses for the financial years 2024 and 2025, mainly due to ongoing pressure on its development earnings. The weak pre-sales performance in Yanlord's latest results is also a concern. This suggests that the company's near-term development revenue and profit margins will remain under pressure. The ongoing property downturn in China is a major factor here. DBS analysts also point out that the window to unlock value in Yanlord's asset-heavy business portfolio might be narrowing. After the recent share price rally, the potential upside might not be as attractive as it was before. As of the latest trading update, Yanlord Land shares were down 6.9% or 5 cents, trading at 0.675 Singapore dollars. This reaction suggests that the market is digesting the news of the downgrade and reassessing the stock's value. So, what does all this mean for investors? Well, it's a complex situation. On one hand, Yanlord Land has seen a significant rally in its stock price, which is positive for current shareholders. The raised target price from DBS also suggests some confidence in the company's value. On the other hand, the downgrade to hold and the expectation of continued losses in the near future are cautionary signals. The company's conservative strategy, while helpful in protecting cash flow, might limit its ability to benefit from any potential market recovery. For potential investors, it might be wise to wait and see how the situation develops. Keep an eye on China's property market and how effectively the new economic measures are implemented. For current shareholders, it's important to consider your investment goals and risk tolerance. If you've seen significant gains from the recent rally, you might want to reassess your position. Remember, investing in property developers, especially those operating in markets facing challenges, comes with risks. Always do your own research and consider seeking advice from a financial professional before making investment decisions. If you guys enjoyed this video, then you're going to love my video titled GIC and AMP Bridgewater on Major Issues Facing Investors in the Future. In it, I dive deep into the insights from two of the world's most respected investment organizations. We explore their perspectives on the challenges and opportunities that lie ahead for investors globally. This video will give you a broader context for understanding how developments in specific markets, like Yanlord Land's situation, fit into the bigger picture of global investment trends. It's a must-watch for anyone looking to stay ahead in the ever-changing world of investing. Check it out to expand your investment knowledge and sharpen your decision-making skills.